Half rate. That's what Lemonade Insurance is now charging Tesla owners, but only for the miles where the car drives itself. Per mile, cut in half, listed on the New York Stock Exchange, no relationship to Tesla. And actuaries deciding on the company's own underwriting model that full self-driving is half the risk of a human driver. Not a press release, a price. And the data they were looking at? Tesla just crossed 10 billion supervised FSD miles, adding nearly as much training data in 4 months as it did in its first 4 years. The actuaries already moved on it. The market hasn't caught up yet. Let's get the number right. Sunday, May 3rd, 2026, Tesla crossed 10 billion cumulative supervised full self-driving miles, 3.76 billion of those on city streets. The hardest driving environment that exists with pedestrians, unprotected left turns, double-parked delivery trucks. For comparison, Waymo announced in February it had crossed 200 million autonomous miles. That's an extraordinary engineering achievement. It's also 1/50th of Tesla's number. There are different kinds of miles. Waymos are level 4 driverless. Teslas are level 2 supervised. But for a neural network learning to drive, the data is the data. And one company has 50 times more of it. Here's the rate. Tesla added the 7th billion mile in late December. The 8th came 53 days later. The 9th came 43 days after that. The 10th took 31 days. The fleet is now adding about 32 million full self-driving miles every single day. And here's the comparison that should land hardest. From 2021 through the end of 2024, Tesla accumulated about 3 billion FSD miles. From January 1st to May 3rd of 2026, 123 days, Tesla added another 2.76 billion. Tesla matched its first 4 years of training data in 4 months. That's a Wright's law curve. Same shape as solar panel cost declines and lithium-ion battery improvements. And it's not just Tesla making the argument. Waymo themselves published the first formal scaling law paper for autonomous driving in June 2025. Waymo confirmed the curve before Tesla hit 10 billion. So back to the actuaries. For 3 years, Tesla and its critics have argued about FSD safety, going in circles. Tesla publishes a chart claiming FSD is 9 times safer than humans. Carnegie Mellon's Phil Koopman says the methodology is wrong. Tesla updates the chart. Koopman updates the rebuttal. The argument never resolves because the people making the claim have a financial interest in the answer. On January 21st, 2026, the argument changed shape. Lemonade Insurance, public company, 3.14 million customers, AI native, launched a product called Lemonade Autonomous Car. When a Tesla drives itself on FSD, Lemonade charges 50% less per mile. Automatic the moment FSD engages. You don't have to be a careful human. You just have to let the car drive. Co-founder Shay Wininger, in the launch announcement, said this, quote, "A car that sees 360 degrees, never gets drowsy, and reacts in milliseconds can't be compared to a human." Lemonade CEO Daniel Schreiber, 3 months later on the first quarter earnings call, put it more directly. Quote, "We are able to price every mile driven per driver, and we recognize AI as a driver, and therefore we can price it accordingly." Here's how it works. Tesla's public fleet API gives insurers onboard telemetry, mile by mile, FSD on miles tagged separately from FSD off miles, with the customer's permission. Lemonade ran it through their own usage-based insurance risk model and decided FSD engaged is roughly half the risk. Tesla isn't a counterparty, no revenue share, no marketing agreement, an independent commercial bet. Now here's the part that should make every viewer pause. The insurance industry's own research arm, the Insurance Institute for Highway Safety, has been on record since 2024. Here's the Institute's president, David Harkey, on systems like FSD. Quote, "Partial automation is a convenience feature, like power windows or heated seats, rather than a safety technology." His head of research added, "No clear evidence that partial automation is preventing crashes." Two parts of the same industry, saying opposite things. The research arm says partial automation isn't a safety feature. The most aggressive insurer just priced it as if it cuts risk in half. One of them is going to be wrong, and we'll know which inside of 3 years. So why does Lemonade think they won't be the ones who are wrong? The cleanest expert you can quote is Andrej Karpathy. He led Tesla's autopilot AI team from 2017 to 2022 before founding Eureka Labs. He left Tesla. His take is independent. In November 2025, Karpathy took delivery of a new Model X, drove it on FSD, and posted a thread on X. Quote, "I'm amazed. It drives really well. Smooth, confident. This is the dream of the complete software 1.0 to software 2.0 rewrite that scales fully with data streaming from millions of cars in the fleet." Software 2.0 is a phrase Karpathy coined himself. The next generation of software isn't written by engineers. It's trained on data. The way he sees it, Tesla just shipped the FSD version that proves the thesis. April 2026, Tesla shipped FSD version 14.3. They rewrote the AI compiler from scratch on a new open-source compiler stack that Chris Lattner originally built. New vision encoder for low-visibility scenarios. Reinforcement learning training stage on top of the imitation learning base. The same recipe that turned text generators into ChatGPT. Tesla claims 20% faster reaction time. Lattner himself reposted the claim. The bet is being tested in the real world. It's getting tested. Robotaxi launched in Austin in June 2025. 20 square miles of geofence, supervised at first. By the end of March 2026, the geofence had grown to 245 square miles, 12 times bigger in 9 months. On April 18th, Tesla launched fully unsupervised Robotaxi in Dallas and Houston. And on May 4th, the day after Tesla hit 10 billion miles, Austin started running unsupervised service at night for the first time. Now look at the volume. End of the fourth quarter 2025, Tesla had about 610,000 cumulative paid Robotaxi miles. End of the first quarter 2026, that number was 1.7 million. Tesla added more paid Robotaxi miles in one quarter than in the entire program before, a 178% jump. The miles are growing faster than the fleet. Cybercab, the purpose-built, no steering wheel Tesla, started continuous production at Giga Texas in April. From the Q1 shareholder letter, quote, "Once in production, we expect that Cybercab will begin to replace the existing Model Y fleet and will be the largest volume vehicle in the fleet over time." Two honest counterbalances. One, federal safety regulators escalated their FSD low visibility probe to engineering analysis on March 18th. 3.2 million vehicles, the last tier before a recall. Tesla's response is the V14.3 vision encoder. Two, a federal jury upheld a $243 million verdict against Tesla in February. A 2019 crash on Tesla's older autopilot system. Driver looking at his phone. Tesla is appealing. One more honest beat. Of the 15 robotaxi crashes filed with federal regulators, Tesla redacted every crash narrative as confidential business information. Waymo, Zoox, Aurora all publish full narratives. Tesla publishes none. That's a choice. And one regulators will pressure test. All real risks. None of them erase the production beat. So how should we think about Lemonade's bet in historical context? Insurance has played this role twice before. Same mechanism, different decade. Airbags, mid-1980s. The insurance industry started pricing airbag-equipped cars lower years before the federal mandate. They didn't wait for proof. Federal Motor Vehicle Safety Standard 208 passed in 1984. Airbags became mandatory September 1st, 1989. Insurance led federal regulation by about 5 years. Automatic emergency braking, 2013 onward. The Highway Laws Data Institute published claims data showing AEB reduces collision claims 7 to 13%. The industry started discounting AEB-equipped vehicles. The federal AEB mandate was finalized April 2024, effective September 1st, 2029. Insurance led federal regulation by about 11 years. The pattern? Actuaries see the data first, They price the risk. Federal regulation follows years later, sometimes more than a decade. The actuaries are the leading indicator because they're the only people in the system whose job is to be right about risk for money with no political cost for being early. Lemonade pricing FSD engaged miles at 50% of human-driven miles is the same move. They've put their underwriting book on the line. But here's the wrinkle. The insurance industry's own research arm, the same institute we just talked about, has formally said partial automation isn't a safety feature. So this is the first time in modern car safety history that the most aggressive insurer is saying one thing, while the industry's own research arm is saying the opposite. Two outcomes are possible. One, the airbags and AEB pattern repeats. Lemonade is right. Federal regulation follows in 5 to 10 years. Two, the institute is right, and Lemonade is the first major underwriting bet that breaks the pattern. 3 years of arguing about FSD safety? One actuary, one product, one number, 50%. The argument is over. The market just hasn't caught up yet. Watch what happens next.